Hello, chartereds. Here we go with the next chapter, Inventories. Namaste, Namaskara, Vanakkam, Namaskaram, and a very warm welcome to everyone joining this explainer. I'm absolutely thrilled to guide you through this must request today for CM8EZ. We're taking the official ICAI material for Chapter 4 and, well, we're transforming it into a clear visual journey. Look, forget rote memorization. Today is all about unlocking the pure, unadulterated logic of accounts. So grab your notebooks, get comfortable, and let's conquer this chapter together. Here's our mission map for today. We'll start with a welcome to inventories. Figure out what inventory actually is. Dive into the golden rule of valuation. Dodge some cost exclusion exam traps. Explore valuation techniques. And finally, face our boss battle, solving sums.
All right, level 1. What is inventory? Now I'm going to deliberately slow the pace down right here. I really want everyone to understand these base concepts perfectly, step by step. Because before we can value anything, we need to know exactly what qualifies as inventory in the eyes of the accounting standards, right? So the ICAI breaks down the definition into 3 distinct buckets. You see, inventory isn't just the finished products sitting pretty on a shelf. It includes goods held for sale, obviously, but also work in progress. You know, the goods that are currently being manufactured. It even includes materials consumed in production, things like maintenance supplies and consumables. But Diane Sisunier, listen carefully here. It explicitly excludes machinery spares, servicing equipment, and standby equipment. Those usually get classified as fixed assets, so don't get tripped up there.
And this comparison brilliantly illustrates how inventory totally changes depending on the nature of the business. Take a look. If you run a trading concern, like a retail shop, your inventory is relatively simple, right? It's mostly just the traded goods you bought to resell. But if you run a manufacturing concern, your inventory is way more complex. You've got raw materials waiting to be used, work in progress out on the factory floor, finished goods ready to ship, and even your packing materials in stores. It's a whole different ballgame.
Moving on to level 2, the golden rule, valuation.
Okay, this is where things get really exciting. Think of this as the ultimate anime showdown of accounting principles. 2 heavyweights enter the ring, but only one can decide the final value of your closing stock on the balance sheet. In the blue corner, we have historical cost, literally what you actually paid to get the inventory. And in the red corner, we have net realizable value, or NRV, what you could actually sell it for today. So who wins? Well, under the grand principle of conservative accounting, the referee rules that you must anticipate losses but never anticipate profits. Therefore, whichever value is lower wins. You always value inventory at the lower of cost or NRV. Purienta, understood?
So the absolutely crucial point here is knowing exactly how to calculate that NRV. It's not just the sticker price. NRV is the estimated selling price, sure, but you have to subtract any estimated costs of completion. For example, if it's a work in progress that still needs some assembly. And you also have to subtract the estimated costs necessary to actually make the sale, like agent commissions or delivery fees. It's the true, final, realizable worth to the business.
All right, level 3, cost exclusions, exam traps.
Now please pay very close attention. I'm dropping my voice a bit because this is serious business. This right here is where ICAI examiners absolutely love to test your conceptual clarity. Not every expense you incur can be magically added to the cost of your inventory. Take a really good look at this list. Normal wastage? That's fine. It's just part of doing business and gets absorbed into the cost. But abnormal wastage, stuff lost due to inefficiency or accidents, is a massive exam trap. Never, ever add it to inventory cost. The exact same goes for storage costs, unless they're a necessary step in the production process. What about administrative overheads? Excluded. Selling and distribution costs? Excluded. Why? Because they do not bring the inventory to its present location and condition. Keep these firmly locked in your mind. So much gay?
Okay, level 4, valuation techniques.
Great job navigating those traps. Now let's unlock the actual techniques used to assign a cost formula to our inventory. The method we choose depends heavily on whether our items are completely unique or if they're ordinarily interchangeable with one another. For items that are interchangeable, we often use FIFO, first in, first out. As the ICAI definition clearly lays out, this assumes the oldest inventory is sold or consumed first. And think about it, this is just good business practice, especially for perishable goods like milk or vegetables or items with rapid technological changes. You obviously want to move your oldest stock out the door first, leaving the most recently purchased goods as your closing inventory.
But what if your items aren't interchangeable? What if you sell, say, expensive, unique medical equipment or custom jewelry?
That's where you'd use the specific identification method. You track the exact cost of that specific, unique item. Then, on the flip side, we have LIFO, last in, first out. This method assumes the newest items are sold first. LIFO is pretty interesting because it matches your most recent current costs directly against your current sales revenue, which gives a very realistic view of current profitability, especially during periods of inflation. Monticello?
And here we are, boss battle, solving sums.
All right, Chartereds, take a deep breath. We've reached the final challenge. It is time for the boss battle, solving the actual sums from the module. I'm going to drop my pace to an absolute crawl right now, so please take notes on this. It's a 3-step combo move for tackling valuation problems, specifically illustration 1. Step 1, identify the historical cost. Step 2, identify the NRV. And step 3, and listen, this is where students always make mistakes. You must pick the lowest value for each individual item. Do not base it on the grand total of all items combined. The golden rule is applied item by item.
Let's walk through this matrix incredibly slowly. We have 3 non-interchangeable products, P, Q, and R. Look at row P. The cost is 38. The NRV is 42. The lower number is 38, so we take 38. Now row Q. Cost is 29. NRV is 29. They're exactly equal, so the least value is simply 29. Finally, row R. Cost is 17, but the NRV has fallen to 14. Under that conservative principle we talked about, we must recognize that loss right now, so the least value for R is 14.
And there is our victorious final number. To get the true value of the closing stock, we simply sum up the winning values from our matrix. 38 plus 29 plus 14 equals exactly 81 locks. It's literally that simple when you follow the logic item by item.
Now let's shift gears just slightly to look at how we calculate average prices, which leads us beautifully into the weighted average price method. It's incredibly logical, really. If you want to find a weighted average price per unit, you just follow these 3 easy steps. Aggregate the total cost of all goods available, count up the total number of units, and then just divide that total cost by the total units. This seamlessly smooths out price fluctuations from different batches.
To celebrate clearing that calculation stage, let's look at the result from the simple average calculation in the module. By simply adding the 5 different batch prices, 50, 55, 55, 60, and 47, and dividing by 5, we arrive at a simple average of 53.4 rupees per unit. Whether you're doing simple averages or weighting them by quantity, trusting the step-by-step formula always leads to the right answer. Zero stress. Arthamayanda?
Before we wrap up today's explainer, I have one final striking question for you directly from the ICII Test Your Knowledge section. Read what's up here carefully. Accounting standards do not permit which method of inventory valuation. Is it A, FIFO, B, average cost, or C, LIFO? Go ahead and lock in your answer. I'll give you a second.
And the correct answer is LIFO. While LIFO matches current costs to current revenues really well, it unfortunately leaves older, often outdated costs sitting on the balance sheet. And that is exactly why accounting standards generally do not permit its use for inventory valuation anymore. You've grasped the logic and cleared the boss battle. But think about this before you go. If technology makes an entire batch of our inventory obsolete overnight, how exactly do we account for a scenario where NRV drops to absolute zero? Keep learning, keep growing, and we'll tackle more accounting mysteries in the next explainer.